Did you know that the system supporting American farmers is unraveling before our eyes? The BRICS Trading Alliance, a powerful coalition of Brazil, Russia, India, China, and South Africa, is not only reshaping global trade but also striking at the heart of American agriculture. Once leaders of global food production, U.S. farmers are now being sidelined in international markets, and the impact is nothing short of devastating. And the most alarming part? This shift is happening quietly. And by the time it catches the attention of the general public, it may already be too late. To understand why American farmers are losing their competitive edge, we first need to look at how the BRICS countries are changing the game in global trade. Historically, the U.S. dollar has been the cornerstone of international trade. But the BRICS nations, representing over 55% of the world's population and nearly 30% of global GDP, are making moves to break free from the dollar's dominance. They're creating their own trading networks, and this is bad news for American farmers. For example, take the case of wheat. In 2023, U.S. wheat exports to China plummeted by a staggering 32%, according to the U.S. Department of Agriculture. Meanwhile, Brazil's wheat exports surged by 40%, largely due to trade agreements within the BRICS framework that simplify trade among member countries. Russia, now China's primary wheat supplier, is also marking a major departure from U.S. grain markets. Agricultural economists explain that the BRICS nations are building a parallel system that bypasses the U.S. entirely by creating their own price discovery mechanisms and trading blocks. They've effectively pulled the rug out from under U.S. farmers. This shift isn't just temporary, it's a permanent restructuring of the global trade order. According to the USDA, U.S. farm exports to BRICS countries have dropped by 15% over the past 5 years, while intra-BRICS agricultural trade has skyrocketed. For instance, Brazil alone exported over $15 billion worth of grain to BRICS countries in 2022. The impact of this trade reordering is profound. As the Wall Street Journal puts it, American farmers are facing a historic decline in the wake of the BRICS trading bloc's expansion. As these new networks bypass the U.S. dollar, American farmers are losing their foothold in global markets at an alarming rate. But why is this happening? How is it possible that the U.S., once a dominant agricultural powerhouse, is now facing a trade deficit in the very industry it helped build? This may seem counterintuitive, but according to the U.S. Department of Commerce, the agricultural trade deficit reached nearly $12 billion in 2023, a shocking turnaround from the surplus the U.S. enjoyed just a decade ago. While American farmers still export vast quantities of crops, imports are growing at a faster rate, and price competition is a major factor. BRICS countries have developed trading systems that allow them to produce and sell goods at prices that undercut U.S. producers. Take Brazil, for example, which has now overtaken the U.S. as the world's largest exporter of soybeans. The country can offer lower prices due to cheaper labor and favorable BRICS trade deals, forcing American farmers to compete on an uneven playing field. In 2022, U.S. agricultural imports hit a staggering $194 billion, while exports lagged at $182 billion. This marked the first significant trade deficit in agriculture in decades, with BRICS countries steadily taking market share from U.S. producers. International trade experts point out that the U.S. simply can't compete with the low production costs and favorable currency trade agreements enjoyed by BRICS nations. But it's not just about the numbers. It's also about the systemic changes that are happening in global trade. For decades, global transactions, whether they involved oil, wheat, or other goods, were processed through the SWIFT banking system, with the U.S. dollar as the standard. This system provided American farmers with a sense of stability, but that stability is rapidly evaporating. As BRICS nations bypass the U.S. dollar and create their own financial systems, American farmers find themselves in a much more volatile environment. Prices for crops like corn, wheat, and soybeans are becoming far less predictable, and profitability is declining. The new BRICS currency trade agreements allow these nations to avoid U.S. sanctions and economic influence, and in doing so, they're able to undercut American agricultural exports. Farmers are now competing with countries they've never even heard of, with prices they can't control. One U.S. farmer explains the frustration: "I used to know what my crops were worth. Now I'm competing with countries I've never heard of for prices I can't control." But even though U.S. agricultural exports remain high, the actual value of those exports is decreasing. In 2022, the U.S. exported $196 billion worth of agricultural products, but farmers were earning less due to falling global prices and increased competition. For example, U.S. soybeans are now being sold at 10% less than they were just 2 years ago as Brazil and Argentina flood the market with cheaper alternatives. The result? Shrinking margins for American farmers, forcing many to reconsider their futures. This economic pressure is compounded by the consolidation of American farming. Once dominated by small family-owned farms, U.S. agriculture is now increasingly controlled by large corporate farms. Many of these corporations operate internationally, and they're better equipped to compete with the low-cost products coming from BRICS nations. A USDA report notes that the number of U.S. farms has dropped by 50,000 in the past decade alone, and smaller farms are being forced out of business or sold off to corporate giants. The small American farmer is becoming an endangered species. A significant factor in the decline of small farms is the difficulty of predicting demand. American farmers have always relied on market forecasts to determine what to plant, but these forecasts are becoming increasingly unreliable as the BRICS trading system distorts global supply and demand. With large portions of the market now closed off due to shifting trade relationships, U.S. farmers are left in the dark. Planting the wrong crop can mean the difference between success and financial ruin. This uncertainty is also behind China's massive cancellations of U.S. wheat shipments. In early 2023, China canceled over 1.7 million metric tons of U.S. wheat, a blow to the U.S. wheat industry, which is heavily dependent on exports. This decision by China to turn away from U.S. wheat is part of a larger shift in global trade dynamics. Wheat prices dropped sharply in 2024, and experts suggest this move is part of China's broader strategy to strengthen its economic relationships within the BRICS bloc while reducing its dependence on U.S. agriculture. As China turns to other countries like Russia and Brazil for its wheat needs, U.S. farmers face growing competition from these regions. Brazil's wheat exports to China have surged by 25%, while Argentina has seen a 30% increase in shipments. This trend is particularly damaging to U.S. farmers who now find themselves in a race they can't win. In 2023, U.S. soybean exports to China dropped by 15%, and corn exports fell by 20%. Brazil and Argentina are taking advantage of this situation, with Brazil's soybean exports to China rising by 18%, and Argentina's corn exports increasing by 22%. The result is lower prices for U.S. farmers, who are struggling to maintain profitability. The BRICS Grain Exchange is one initiative that's accelerating the shift. This new exchange facilitates trade among BRICS nations at preferential rates, reducing reliance on Western markets and allowing member countries to negotiate better terms. The exchange has already had a significant impact, reducing global grain prices by 5%, and altering the balance of power in the agricultural trade. According to trade experts, this exchange shifts the power dynamics in international agriculture, putting non-BRICS countries at a disadvantage. Meanwhile, China's reduced hunger for grain is sending shockwaves through global markets. As China increases its domestic grain production and reduces its reliance on imports, global grain prices are fluctuating unpredictably. The financial instability caused by these shifts is creating even more challenges for U.S. farmers. So what does all of this mean for the future of U.S. agriculture? The BRICS trading system is fundamentally changing the landscape, and U.S. farmers are at risk of losing even more market share. As trade patterns shift and prices decline, American farmers are being squeezed out of global markets. The consequences could be severe, affecting global food prices and the financial stability of American agriculture. As we continue to watch these developments unfold, it's clear that the stakes are higher than ever for U.S. farmers. Will they be able to adapt to the new trade realities, or will they continue to lose ground to BRICS nations? Only time will tell. If you found this video insightful, be sure to like, comment, and subscribe. Your support helps us grow, and we appreciate your feedback.